Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They're commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. Every year, we like to take a moment to share with you, in the first Under the Lens video of the year, what we feel will be the 6 major themes for the coming year. We'll follow that with the first long-wave video of the year, taking those macro themes and extending them to what the investment themes are then likely to come from them. The themes often reflect thinking that stems from the just completed research for the thesis paper for the year just published. In 2013, it was the unfolding Great Stagflation. Last year, it was the new regulatory state. Both had concerning tones of what lies ahead for primarily the U.S. It was refreshing this year, therefore, to write the much more optimistic thesis paper on the unleashing of America, one of hope, optimism, and frankly, even a little excitement. Though the headwinds of achieving much of what is in this year's paper are incredibly large, our investment research suggests that at least we are heading in a sounder economic direction. The last 2 years of themes are summarized here. We got 4 of the 6 right. As is often the case, we were early on one and believed the government reporting distorted the other. What we got right: first, the U.S. debt exploded and has become a systemic problem for the nation. 2, over 50 global banks began aggressively cutting rates, with the U.S. kicking them off with a jumbo 0.5 percentage point reduction in September, followed by a 0.25 percentage point cut in November and 25 basis points in December. The Fed has lowered rates by a full percentage point since September. Thirdly, global geopolitical tensions heightened, taking us back to the Cold War era. And fourth, the slowdown in China has become much worse than anticipated. What we got wrong? We never got a recession, at least based on the government deflator reporting of real GDP. And secondly, scarcities and blackouts were not as serious as we anticipated, though for some areas they would disagree with that. This year, we anticipate the following. A fallout between credit growth and the wealth effect will show itself stemming from the blowback from global tariffs and sustainable national debt levels. Secondly, the fourth turning has arrived, and we'll see it through the global populist leadership shock already underway, led by the U.S. Thirdly, the negative fallout from global immigration will be felt. Fourth, a new Cold War will become a hard reality. 5, the global economy will slow. And the 6th is we will see the emergence, finally, of shortages and scarcities. Before you might immediately dismiss some of them, let me go through them so you know what I am specifically identifying. Let's start with what I mean when I differentiate between the wealth effect versus credit. It may not be what you think. You've seen this chart many times, which is shown here to remind you that today the global economy, and the U.S. specifically, is dependent on credit growth, where credit and debt are opposite sides of the same coin. Without real credit growth of over 2% annually, the wheels soon come off the GDP economic engine. As it is now, real credit growth is falling below 2%, while U.S. GDP growth is not keeping up with the growth of the national debt and its exploding financing burden. What is keeping the machine greased is that the growth in wealth is making up for the organic economic credit growth, as new market exchange wealth is fostering credit growth both in its newly created collateral value and foundational leverage. The red circle shows the impact in 2008 of a small impact on credit having on wealth. Today, the exposure is falling wealth, seizing up credit, and a potential uncontrollable symbiotic spiral occurring because of the magnitude and dependencies built into the system to the vast derivative complex. With this in mind, we also need to remember that the U.S. consumes vastly more than it produces. The imbalance in trade and fiscal deficits, which must be financed by borrowed capital, is now draining global capital growth. This has become so accepted that it is all just old news to everyone. However, the U.S. has just elected a new Trump administration. We believe Donald J. Trump not only recognizes these problems, but believes the only longer-term solution for the U.S. is trade tariffs. The world is living off and dependent on the U.S. consumers' willingness to take on unprecedented debt levels. Trump believes placing a toll on that access in the form of a tariff to the U.S. market is the first step in avoiding a U.S. debt crisis in the near term. To Trump, tariffs are effectively a toll for access, which is but step one in his Trump card strategy. The second is to give foreign manufacturing corporations tax incentives to move final assembly and elements of their manufacturing to the United States, both to avoid the tariffs and to take advantage of tax incentives for hiring U.S. workers. Step 3 is the revitalization of the American economy by repatriating some of the 54,000 manufacturing facilities that left the U.S. 25 years ago. We have talked about Trump's potential reshoring strategy in a prior video for new subscribers who may have missed it. This all sounds theoretically possible. However, the fly in the ointment is the resurgence in inflation while this is potentially occurring. Even if this is possible, the transition will bring increased inflation and increased U.S. debt levels. It is a highly risky gamble, which we lay out in this year's thesis paper. It is a major risk, therefore, to the 2025 macro outlook. That is, the potential for it working in a timely fashion. Our second theme is the impact of what we term a global populist leadership shock. We are in the midst of the well-documented by Neil Howe and William Strauss of the fourth turning. The fourth turning aligns with many other longer cycles developed by both Harry Dent and Martin Armstrong. As expected from cusps in these cycles, we are seeing societal shifts in attitudes to governance. Today, this is taking the form of a shift towards what we can best describe as populist beliefs that the ruling institutions are no longer serving the needs of the people. In the top list of countries, we highlighted just some of the larger countries facing societal turmoil with the emergence of new parties that are challenging the status quo. A sense of anxiety is showing in election polls where the old is being replaced with new, emerging populist parties. There is something happening across the planet. What seems to be unfolding around us is nothing less than an ongoing collapse of the world's globalist regime. The first clear sign that something truly big may be happening was the historic comeback and victory of Donald Trump in last November's election. Donald J. Trump's victory stems from the takeover of the Republican Party by his America First political movement. 8 weeks later, the Canadian Prime Minister Justin Trudeau announced his resignation. It now appears increasingly likely that in the coming weeks we will see the fall of ruling governments and coalitions in Austria, Germany, France, Britain, maybe others such as Romania are likely to follow. In the bottom, we show China and Japan as examples of large countries under turmoil from economic policies that are becoming societal hotspots. In a recent newsletter, we went through all of these, so we would refer you to it. Free newsletter sign-up in our archives are available at the Matasi.com website. Global leaders and technocrats that run these Western governments are losing their grip on power. The pool of popular discontent has been filled to the brim by self-serving actions of the globalist elite. It seems to be reaching the point of boiling over. They are being roundly booted out by the populist movements across the world. A crisis of political leadership and policy paralysis is occurring. There are two central social issues for incumbent global governments that are causing massive populist resurgence at the polls. One is inflation, and two is immigration. A resurgence which is altering policies that foster globalization, financialization, and modern mercantilism, which we've talked about throughout 2024. Incumbents are being punished for inflation and immigration policies. Incumbent governments were given a kicking by furious electorates who had suffered a huge drop in their standard of living, and it made not the slightest difference whether the incumbents were left-of-center Democrats in the U.S., centrist Macronists in France, or right-of-the-center conservatives in the U.K. In the case of excess inflation, loss of well-being was genuine. Yet since peaking in 2022 at close to 10%, inflation has plunged to the low single digits. So why is everybody so angry? It's actually about cumulative inflation that really matters. One of the main reasons that central banks target, in fact, 2% inflation is that 2% is the highest rate of inflation that goes largely unnoticed. Going largely unnoticed, households and firms do not consciously factor sub-2% inflation into their price and wage setting process. This prevents an inflation spiral taking hold. The reason that sub 2% inflation goes largely unnoticed is that economic productivity also tends to rise at 1 to 2%. And to the extent that wages rise in line with productivity, people will not suffer a loss of purchasing power when prices rise at 2% or below. So the inflation basically goes unnoticed. The thing that people really notice and hate is the cumulative loss of purchasing power when prices keep rising at above 2%. Telling people that inflation is back down in the low single digits will not make them feel any better when they have just suffered a cumulative loss of purchasing power of 25% in the last 4 years, as in the United States. Our third theme for 2025 is the fallout from immigration. Here, too, the title may be a little misleading. To be clear, a major problem in the developed countries is actually too low a level of immigration. The issue we see today is not immigration, but rather how it is being handled in all these various countries. To understand why there is fallout from immigration is to start with the fertility rates. Fertility rates are declining everywhere. In North America, the fertility rate per woman is 1.6. Unless it is above 2, the population will shrink. If the population shrinks, then productivity will fall without immigration or increasing in some fashion the total population. If productivity falls, then standards of living will fall. This chart from the UK Financial Times shows recent productivity growth is insufficient to sustain improvements in living standards in most large advanced economies. The pink line shows what productivity growth is required to maintain GDP per capita growth. A McKinsey report investigating the economic impact of declines in birth rates found that the UK, Germany, Japan, and the U.S. would all have to see productivity rise at double the pace seen over the past decade to maintain the same growth in living standards witnessed since the 1990s. The consultancy report showed that to match GDP per capita growth between 1997 and 2023, productivity growth in France and Italy would need to triple over the coming 3 decades. In Spain, it would need to rise fourfold between now and 2020. Without action, younger people will inherit lower economic growth and shoulder the cost of more retirees. While the traditional flow of wealth between generations erodes, governments globally are struggling to contain a demographic crisis amid rising costs for housing and childcare, as well as social factors such as fewer younger people being in relationships. 2/3 of people now live in countries with birth rates per woman below the so-called replacement rate of 2.1, while populations are already shrinking in several OECD member states, including Japan, Italy, and Greece, along with China and many Central and Eastern European countries. The report follows similar warnings by the Paris OECD, which last year said declining birth rates were putting the prosperity of future generations at risk and urged governments to prepare for a low fertility future. McKinsey calculated that in Western Europe, the decline of the proportion of people of working age could dent GDP per capita over the next quarter century by an average of $10,000 per person. The consultancy argued that more countries will have to encourage people to work for longer, following the example of Japan, where the labor force participation rate among people 65 years and older is 26% compared with 19% in the U.S. and 4% in France. The consultancy calculated that to keep living standards rising at the same rate, a German worker would have to work 5.2 additional hours per week, or the share of the population in work would need to increase by nearly 10 percentage points from its current level of nearly 80% among people aged 15 to 64. The UK and US require a lower level of additional work thanks to more favorable demographic prospects, but Spain and Italy would also need an increase in the share of people in the labor force by double-digit figures. The fourth theme is a new Cold War. Whether it's the Ukraine and Russia, Taiwan and China, or the Middle East and Iran, we have serious conflicts among the major powers globally, as well as regional issues in Africa, the Arctic, and emerging issues in South America. As a consequence, we have military buildup. China has officially placed itself on a war footing and is preparing accordingly. Russia has walked away from long-held nuclear arms agreements. A well-financed Iran from oil revenues is moving towards nuclear weapons. North Korea has troops in Ukraine supporting Russia. The U.S. is sending missiles now to the Ukraine and increasing the size of the U.S. Navy. All signs of escalating conflicts. We also have NATO expansion and funding increases. NATO is strengthening dialogue and cooperation with partners in the Indo-Pacific region, Australia, Japan, the Republic of Korea, and New Zealand. I thought NATO stood for North American Treaty Organization. NATO is looking now to increase defense budgets by member countries to 5% from the previous 2%. As well, we have a 21st century Monroe Doctrine. The U.S. is moving towards a Monroe Doctrine 2.0 with the taking back of the Panama control from stealth China control and potential annexing control of Greenland. At least this is what Trump is strongly proposing or looking at. A lot of this is the further escalation of many of the trends we outlined in our 2000 thesis paper, Global Conflict. Our fifth 2025 macro theme is a slower global economy. This is most clearly evident with the deterioration in China's global import-exports trade. Global demand growth is weakening. As this chart shows, earnings sentiment is in the early stages of reflecting this and turning down. Sustained elevated equity market valuations are causing analysts like Goldman Sachs to now take down annualized 10-year returns quite significantly. We have reached the point where credit growth is becoming problematic. We discussed this earlier concerning specifically the wealth effect's influence on credit. This yield curve chart, which guided us during the 2000 dot-com implosion on the left, as well as the 2008 financial crisis, is now giving us the same early warnings we received then, as indicated by the red arrow on the right. All three panels match almost perfectly. Additionally, the high-yield credit market, as represented by junk bonds, has begun to turn down rather hard. This was the area the Federal Reserve had to immediately bail out during the 2008 financial crisis when zombie corporations were only a fraction of what they are today. Over 20% of the major market participants are now considered zombies where earnings no longer support debt payments and they must borrow to stave off bankruptcy. This area could get ugly fast in 2025 if interest rates don't fall quickly and the credit markets maintain their liquidity. The concentration of market cap has always been a warning sign to markets. We have never had this sort of concentration with 7 major corporations before within the U.S. nor within global markets. If the Magnificent Seven even hiccup, we will have serious disruptions. With markets tracking earnings per share so closely while buybacks are employed to reduce shares to boost earnings per share, it is hard to see how this can continue by either increasing margins or borrowing to finance share buybacks or a combination of both. Our sixth theme is one we carry over from 2024, the emergence of shortages and scarcities. We're already seeing the beginnings of wave 2 we have already called for in inflation. Service inflation continues to be problematic for the Federal Reserve. As some of the prior themes began to unfold, as we expect in 2025, scarcities and shortages can be expected, not too dissimilar to what happened to the supply chains during this pandemic. This time it likely won't be a pandemic, but rather a shortage of credit and liquidity and supporting collateral for a highly leveraged derivative complex-driven financial structure. So what can we conclude? It really comes down to the Trump administration's ability to pull the rabbit out of the hat. The headwinds facing the new U.S. administration are daunting, to say the least. The risk they are assuming with their tariff strategy appears to be an almost Hail Mary in the face of what America now faces. Let's pray that my calls turn out to be lower than 4 of the 6 from last year. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will take that money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there's actually seldom been a better time for investing. However, it requires careful analysis and not following what has been traditionally the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed professional financial advisor. So until we talk again, may 2025 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.